listening to Turning Hard Times into Good Times with your host, Jay Taylor. If you have a question or comment about today's show, Jay would love to hear from you at 1-866-472-5790. That's 1-866-472-5790. You can also send an email to questionsfortaylor@gmail.com. That's questions, the number 4, Taylor@gmail.com. Now, back to our program.
Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm glad to have a special report today to pass along to you. Talking to Bob Moriarty. Bob has been on our show in the past. He was born in New York in 1946, which makes him 1 year older than me. But he has a very colorful history as a military pilot, and and as a civilian did a lot of work flying airplanes across the Atlantic as well. I'm really glad to have him with me because not only is he, the pilot stuff doesn't have a lot to do with what we're going to talk about today, but except that it sort of points to his character. And he is quite a character. He is quite a thinker and an individual. I would underscore that. More than anything else, I love Bob because of his individuality and his ability and his willingness to pass on his unique thoughts to us. Thanks for joining me again, Bob.
Well, I'm not sure having unique thoughts is the same thing as having good thoughts or valuable thoughts, but that's a very nice compliment on your part. I'm glad to be here.
Well, you're an individual, and in a world in which we are being increasingly discouraged from being individuals, you're a unique thinker, and yes, a lot of good thoughts, a lot of very profitable thoughts, which is why we wanted to have you on as well. We really want to talk about your book today, in Basic Investing in Resource Stocks, The Idiot's Guide. And, that would pretty much allow your book to be applicable to most human beings, I suppose, because I think it's only imbeciles maybe that are below idiots, but we may have a few of those around. But most people, I like to think, even though they're not being encouraged to do their own thinking, are still something above the imbecile level. So idiots, and those of us who like to think of ourselves something a little better than that, I'm sure can profit from your book. Chapter 1 of your book, you state, or the chapter 1 of your book is titled State of the Union. And it was pretty good. It was prior to 1971, I would say the state of our union was pretty good in many ways. This is my thought anyway. Tell our listeners what happened in 1971 and why that year is so important in understanding the existing political, economic, and market mess that we now find ourselves in.
Well, that was a pivot point. On October 15th of 1971, Richard Nixon broke the link between the U.S. dollar and gold. And basically, it was like somebody handing you your rich uncle's Platinum American Express card that says, knock yourself out. So the United States did. Now, you got to look at it in context. And actually, the Vietnam War had already bankrupted the United States. Wars always do that. That's why I'm so against war. But Nixon broke the link. All of the inflation of the 1970s was due to the cost of the Vietnam War. Mm-hmm. And what we did literally is we exported our inflation to the rest of the world. And unfortunately, every other country in the world has learned from the experience of the politicians at the central bank in the United States and said, well, hell, if the United States can do it, why can't we do the same thing? It used to be very unusual for Europeans to use credit cards, and very few of them actually had debit cards. Europeans use cash for everything, including cars and including houses. And that's changed, and the world has got on this spending spree, and it's now $250 trillion in debt. And anybody that ever passed Economics 101 knows we don't have $250 trillion worth of assets in the world or the ability to repay that money. So there's a lot of people holding pieces of paper in their hand that are going to have no value. I just sent you a piece by Martin Armstrong.
Yes.
And while I'm a little dubious about some of Martin Armstrong's claims, He is brilliant at marketing, and he's certainly brilliant at thinking. He's one of the most brilliant people I know. And when he hits it out of the park, he really hits it out of the park. And he says, we're going to have the big crash this year. And in the book, and I went way out on a limb in that first chapter, and bear in mind that was written 3 months ago, and I said 2019 was going to be the year of the big reset. The crash that lots of people have seen coming for lots of years is here right now, and most people don't see it.
Yeah, I think that's right. I mean, I think you only have to look at the pivot, let's say the Powell pivot, at the start of this year, after it looked like we were heading into the into a downward spiral in the equity market, and it's very clear that raising interest rates or allowing rates to rise to the equilibrium level cannot occur without some extreme pain ahead of us. And so what they're going to try to do, obviously, Bob, is delay the day of reckoning and start printing more money. How long can that go on before something gives?
Yeah, I've used the analogy in the past. It doesn't make any difference how big a balloon you blow into. As long as you keep blowing into a balloon, one of the things that you know is going to happen, sooner or later it's going to explode.
Right.
Now, I'm going to look either really smart or really stupid in a year or two, because I said it's here, it's now, and it's happening. And I'm sorry, but I'm convinced it is.
Yeah.
And to a certain extent, I think Martin Armstrong has just said exactly the same thing.
I think he has, and basically I glanced at that article, and he's talking about the illiquidity in Europe, primarily in Turkey, for example. The Spanish banks have always assumed that the IMF would always bail Turkey out, wouldn't allow them to go, the NATO country that they are and all. But the Turkish lira is crashing, and so those people that have, the Turks are having a hard time paying back their foreign loans, and there's similar problems in South Africa and Brazil. So this illiquidity issue, I know Danielle DiMartino Booth has been talking about it, and I've had her on my show recently as well, and she's saying much the same thing. So, we can hope and pray that's not the case, Bob, but I'm afraid you and Martin Armstrong may very well be right. To what extent? Go ahead.
Here's the issue. It's not really lack of liquidity. It's insolvency.
Mm-hmm. Mm-hmm.
Okay, the Turks are not illiquid.
Yeah.
They're insolvent.
Yes.
And there's enormous difference between the two. We see the lack of liquidity, and that's very obvious. But, guys, it's simple. There's $250 trillion of debt in the world. It is not going to get paid.
Right. Yeah, well, that's right. The insolvency, I think, ultimately ends up resulting in illiquidity of one form or another. But anyway, to what extent can you tie the current liquidity problems, or let's say, so Nixon removed gold from money in 1971, and that has resulted, as you say, in this massive amount of inflation, starting with Vietnam. It hasn't ended. So to what extent and how was the United States able to continue having the dollar as the world's reserve currency, even though it had nothing of any intrinsic value underneath it?
Well, that's interesting. The Dutch have had the world's reserve currency. The French have had it. The British have had it. The Russians obviously have never had it. For 18 out of the last 19 centuries, India and China were the world's biggest economies. What has happened is this enormous financial confusion, okay? But the dollar is at the end of time. And while the short term is probably very positive for the dollar, it's going to destroy the financial system of the world. But the reality is, since 1944, there haven't been any other alternatives.
Bob, we talk about this impending doom, but I dare say that most people aren't focused much on it. I would think that, having escaped the 2008 disaster, most people think the PhD economists at the Fed will always somehow save us. What do you say to them? Or you just let them think what they want to think if they're not willing to listen and read your book and listen to other wise advice from other people? What do you say to these people?
That's a really good question. That's a brilliant question. And I'm going to say something that's as direct as I could possibly be. I did not write that book for stupid people.
Even though it says it's for idiots.
No, it doesn't say it's for idiots. Oh. It says the idiot's guide. Okay. And on the first page of the book, I make it crystal clear that I'm the idiot and people can learn by reading the mistakes that I've made. I've made every mistake that you can make in investing. I lost a ton of money yesterday in Miramont because I believed somebody who was lying.
Yeah.
So they don't have to make their own mistakes. They can look at the mistakes that I made. Stupid people are absolutely not going to buy my book. Intelligent people who want to learn from somebody else's mistake, they're the audience.
Yeah.
And they're reading it and people are saying, hey, I learned some things that are very valuable to know. Out of the first 15 reviews, 14 of them were a 5. It's very highly regarded and people are saying, hey, I'm going to keep the book and read it, reread it, reread it, reread it. It's a good book.
Yeah, it definitely is. In chapter 3 of your book, you talk about Moriarty's dozen rules for investing. Maybe we could talk about a couple of those. You said the first one is all markets are manipulated all of the time by everybody involved. If you can't handle that, don't invest. And this, of course, is an issue among gold bugs. The notion that the gold market is capped. The GATA people talk about how the gold market is capped by massive amounts of paper money being pushed in or being actually just thrown into the markets. And I think that seems to, on its surface, seems to make a certain amount of sense because as much paper gold is traded in a day as gold produced from the ground in a year or something like that.
Okay,
but how do you address that, Bob?
Hang on for just a minute. Gold went from $252 in August of 1999 to $1,923 in September of 2011. Do we agree that's fact?
Yes, that's a fact. Yes.
Okay. Was it suppressed?
Well, if it was control. If it was suppressed, it wasn't completely suppressed. Let's put it that way. It was certainly allowed to rise. It certainly rose in price. So if there is a suppression going on, it wasn't a very successful one.
You're dancing around a really simple question. Let me ask a question a different way. Silver got down to $4.02 in November of 2001, and it hit a high of just under $50 an ounce in April of 2011. Was silver suppressed?
Well, it certainly wasn't suppressed totally.
Well, let me put it a different way.
I mean, I think the silver bugs a lot of them were saying, well, yeah, it would have gone to $1,000 if it wasn't suppressed or whatever. But anyway, yeah, who knows? The point is that if they could really have their own way, I think it was somebody during the Johnson years that suggested that gold should be $4 an ounce or something like that. Obviously, they can't suppress completely for sure. But you're saying, all right, go ahead.
Here's what's funny. Talking about suppression of gold and silver, that was one of the greatest rallies in history for both gold and silver. To even use the word suppress in the same book, it's absurd.
Yeah.
Okay. Now they've fallen back from the suppression. They're back to the manipulation. Now, if all financial markets are manipulated, why would you care?
Ultimately, what you're saying is reality will prevail.
No, I'm not saying that at all. I'm saying all financial markets are manipulated. Jay, the sun is going to come up tomorrow in the east.
Yeah.
Let's not argue about it. Let's not discuss it. It's going to come up in the east. That's a fact of life. And the beauty is in the book, and I would challenge anybody to come up with a better way of saying it. I put it as directly as you could put it. All financial markets are manipulated all of the time by everybody. If you can't handle that, don't invest.
So when I buy 100 shares of Newmont, I'm manipulating the market?
Of course you are.
Okay, all right. Well, let's go on to some of the other some of your rules for investing. The dozen of them. Markets deviate from the mean and always regress to the mean. So I guess what we need to do is look at the mean in any given market and know whether we're overpriced or undervalued. It's easier said than done, though, isn't it?
I don't think so. Let's talk about the ratio between silver and gold.
Uh-huh.
Now, if we remove the dollar from the equation, and we don't talk about silver in terms of dollars, we don't talk about gold in terms of dollars, we only talk about silver in terms of gold, the ratio has varied between 16 to 1 and 100 to 1 over the last 100 years. The mean is 53 to 1. So what you could say is that when the ratio is, say, above 84 or 85 to 1, that makes silver cheap and gold expensive. And when the ratio gets down to 35 to 1, that makes silver expensive and gold cheap. You can invest just based on that. And all you have to do is look at the ratio and say if it's above 53 to 1, eventually it's going to go below 53 to 1. And if it's below 53 to 1, eventually it's going to go above 53 to 1. Let's take a look at palladium and platinum right now. Now, historically, platinum has always had a premium to gold. And for literally most of the time, like 99.9% of the time, it's had a premium to platinum or to palladium. But palladium got up to $1,600 an ounce in the last week or so, while platinum's about 820 or 830.
Yes.
Selling palladium and buying platinum would appear to be a fairly risk-free investment. Likewise, selling palladium all by itself would seem to be a good investment, or buying platinum all by itself would be a good investment. What I'm trying to do is take out the mumbo jumbo, take out the gold as a religion, take out the gold as suppressed and naked short selling, and COMEX is going to default, because all of that is noise and it's not signal. I'm trying to show investors they don't have to listen to all the malarkey. If they will think for themselves, they can make reasonable investment decisions.
All right. So some of the other rules that you have in Chapter 3 to start the chapter: markets go up, markets go down, markets tend to overshoot, and when they do, there is often an equal and opposite move. With an investment, buy cheap and sell expensive. I mean, these are just common sense things, and there's 12 of them there. In Chapter 10, you talk a lot about gold mining companies, gold investments of various kinds. People should really take a look at that, because there's a lot of just sound, good, sensical advice there. You talk about the different kinds of gold mining companies, the big ones. You talk about ETFs. You talk also about mutual funds and those kinds of investments that people don't have to pay as much attention to, perhaps just in terms of individual stocks. You also talk a lot about sort of the mid-tier producers and the exploration stocks. Do you have some advice to give to people with regard to what kind of gold investments they should make depending on their makeup, their personality, their age?
Well, that again is a really good question, and to the extent that what I've tried to do in the book is show the variations that are available. A person 90 years old probably shouldn't be buying expiration juniors. A gold mutual fund or even an ETF would probably be better for them. But depending on how liquid a person is, what their objectives are, how much money they've got, are they going to have higher income in the future? Are they trying to retire? Every individual investor needs to think about what is best for me, what is safest. The major mining companies are the safest. However, in a bear market, everything goes down. They just don't go down with like 90% like juniors will.
Yes.
In a roaring bull market, the biggest piece of crap stocks out there that start off at 4 cents are going to go to $4. Okay.
Yes.
So what I'm trying to do is show people, give them some historical reference point of what's happened in the past. The strange thing is when I started writing the book, I realized that, everybody wants to talk about country and they want to talk about commodity and they want to talk about interest rates and they want to talk about central banks and they want to talk about manipulation and suppression. And it's all bullshit. All of it. Okay. When BRIAX happened in 1996, every gold stock went down from there until 2001. From 2001 until 2008, pretty much everything went up. So, you could look at all the things that people are writing about and talking about, and they were meaningless. You need to figure out where you are in the cycle. Now, just as a matter of reference, for both silver, gold, and platinum, between August of last year and December of last year, the sentiment was more negative than it's been in all of the time Sprott has been running their silver, gold, and platinum ETFs. So from a sentiment point of view, and I put a lot of credibility at sentiment, now is just about the best time you could invest.
Yeah, and certainly we should remind our listeners that 321 Gold, you have constant information there, some of which some of which comes from you directly, and from a lot of other sources. So people should go to 321 Gold to learn a lot about some of these ideas, sentiment, other things. Well, I do know that during bull markets, you see the indexes, the gold share indexes, they might go up 5 or 6 fold, but then they can lose 80% of their values very, very quickly. So knowing whether you're in a bull market or bear market for the precious metal stocks are very, very important. We're just about out of time here, but on page chapter 13, I count 18 helpful hints that you pass along to your readers. Perhaps we could talk about a couple of those, Bob. What would you say would maybe a couple of the more important ones?
Oh, now you're asking me what's in the book I wrote. You got the book.
All right. Well, I have in front of me. Here's some of them. In a boring market, a company's positive news release may only provide a liquidity event rather than propelling its share price higher. Liquidity is your friend. Learn to love it. Could you give some examples of that?
There are companies, and there's one that I wrote about, and you and I have talked about, Rise Gold.
Yes.
Has come up with excellent drill results 2 times in the last 2 or 3 months. And I really believe the stock would go up 50 or 100%. And it didn't. All it did is provide a liquidity event. Somebody unloaded shares into it. Liquidity is one of the best indicators, sentiment indicators you could have. When the market is ultra liquid, that's always a good time to sell. And when it's totally illiquid, that's always a good time to buy. I'm trying to show people that there's 100 signals that nobody ever talks about that will give you a lot more information than listening to Bill Murphy.
Well, I think that might be a good place to leave it, Bob. I mean, there's just so much more to talk about, but we really can't go much longer than this. It's 321 Gold is where people should go to follow Bob and a host of other people that provide their wisdom there. A lot of great information there. A lot of the companies that Bob is involved with and works with. A lot of good ones that I've started to follow as a result of finding them at 321 Gold. And Bob, where can people pick up a copy of your book, Basic Investing in Resource Stocks: The Idiot's Guide?
They can get it in Amazon, and we've got links to it on our homepage.
Excellent. Very good. All right. Well, Bob, thank you so much for spending time with us today, and we'll look to keep up with you as this bull market progresses. Thanks very much for being with us again.
Good deal. Thank you, Jay.